Hi everyone, this is Ruturaj and welcome to our channel Join. So today we'll be adding one buy position and analyzing in Opstra. So say for example, we'll be analyzing on Reliance share. So now just select options here. Say for example, the expiry is 26th August 2021. Then choose a strike price. Say for example, we want to buy a call option. So just choose that 2100 is our strike price, and then it would ask like you want to do call or put. So we want to buy a call option because we believe that Reliance price might go above 2100. So we are bullish, so we are buying a call option. So here it would ask whether you want to buy or sell. So we are buying a call option, and then it would ask like how many lot quantity you want to buy, one or two or anything you want to, but currently would be just dealing with only one lot. So this is the option price, that is 57.55. So this is per share. Remember that you need to multiply the lot size, that is 250. So this is the per share premium that you need to give to the seller, right? So let's add the position. Once you do this add position, you can see, just scroll down a bit. Here you can see that this is the payoff chart that we discussed in our lecture also. So here you can see that for the option buyer, even if you have like bought at a 2100 strike price, you would be earning the profit after this break even is crossed, that is 2158. You can see the green zone here. So after this price 2158, if Reliance price crosses 2158, then only you would be earning profit. Here you can see the max profit. This is undefined, that is infinite. So as much as Reliance would be going up, you would be earning profit. So max profit is infinite. And max loss, you know that this is the premium amount that you have given. So you can calculate it, that is 57.55 multiplied by 250. So this is the required premium. So you need to give this to the seller, right? So in worst case, this is the maximum loss. You can also see this in this payoff chart. So in this red zone, you can see this is the maximum loss, that is the flat curve. Okay. So this is 14,388. And remember that this is the break even. So if it crosses break even and rises, then only you would be earning profit. And this is max risk to reward ratio that we discussed, but I don't personally use this in options. In shares level you can use this, but in options I don't think this is of much use. So this is the thing. And also you can see the different Greeks parameters that we learned. Just select this Greeks. You can see here, this is the implied volatility, and these are the different Greeks that we learned. These are delta, theta, gamma and vega. You can convert it to decimals if you want, or you are convenient with the decimals. I am personally convenient with this decimal, so I convert it to decimals. So you can see the delta value is 0.72, theta is minus 1.04, gamma and vega and so on. So these are different things that you can see here. So payoff chart and Greeks are the most important things that you need to know. Ignore this futures chart and P&L for now. We'll be looking at it maybe in future. So I hope you got this thing, how you can add, you can also like, I would recommend that you add different options, call options and put options here, like buyer and seller. Lot of things you can do. You can modify here all the things also. Just click in this edit button and you can modify the things as well. Say for example, we convert this same position to sell side or seller side, then do modify. Then here you can see that the estimated margin required by the seller is 1,12,836 and the net credit is 14,387.5 rupees. This is the same amount that the buyer is giving to the seller. This is the premium amount. So the seller needs to maintain this margin as we discussed, and the seller would also get additional 14,387.5 rupees from the buyer as premium. So if the seller wins, then this premium entirely belongs to the seller. So here you can see, even if the seller has, like, we have sold the call option at 2100, the break even is 2157. This is because of the premium of 57 rupees. So that means seller would win if the price is below 2157, right? Not 2100. The seller would actually win if the price remains below 2157. So you can see how much profit the seller would be getting. You can see that the seller's profit is actually constant. So the maximum profit that the seller can earn is the premium amount, that is 14,388, and the maximum loss that the seller can make is infinite. This is the same as the maximum profit that the buyer can make. So you can imagine that we also discussed this thing. The maximum profit that the buyer would be making is the actually the maximum loss that the seller would be incurring. So similarly, you can try out other different parameters as well. I hope this video is informative. In the next video, we would be with some new concepts. Till then, take care. Thank you. Bye bye.